Why the best CRE deals don't look good on paper. And we're going to talk about value add and expense optimization today. And in commercial real estate, the best opportunities rarely arrive perfectly wrapped in perfect financial statements. And most inexperienced investors chase shiny properties with strong occupancy and polished marketing packages and clean trailing financials. The problem is that everyone else wants those deals as well. So the real wealth in commercial real estate is often created by identifying the underperforming properties with operational inefficiencies, below market rents and deferred maintenance and poor management or hidden upside potential. Basically, the good deals that don't look so good. And that is where the value add investing and expense optimization strategies become powerful wealth building tools. And at the Viking Enterprise team with eXp Commercial, we help investors identify opportunities where strategic improvements can dramatically increase net operating income, or NOI, and in turn, property value and long term cash flow. So, what is a value add commercial real estate deal? Well, a value add CRE investment is a property that is currently underperforming but has measurable upside potential through improvements, repositioning, or operational efficiencies. So these properties could include ones with poor management or high operating expenses, or vacancy issues, or outdated interiors, or below market rental rates, or a weak tenant mix, or a lot of deferred maintenance, or an inefficient utility usage, or underutilized land or space around the property. And many investors avoid these deals because the financials initially appear weak on paper. But experienced commercial investors understand something important. Property value is often created and not simply purchased. So why bad-looking deals can become great investments. And commercial real estate values are largely driven by income. And when investors improve NOI, they often create substantial equity growth. And even relatively small operational changes can significantly impact value. So, say for example, we can buy a property, increase rents, or we can reduce the utility expenses that the landlord's paying, or replacing inefficient vendor relationships, or improving the occupancy of the building, and renegotiating contracts and improving tenant retention will all help in repositioning the property. And these changes compound over time, small changes every day. And in many cases, investors create more wealth through operations than appreciation alone. So let's talk about the power of NOI growth. And one of the most important concepts in commercial real estate investing is understanding how NOI will affect your property valuation. And net operating income is a simple concept, but it's basically your operating income, whatever your total rents are, minus your operating expenses. And commercial property values are often estimated using capitalization rates or cap rates. So value is equal to the NO or the cap rate, the net operating income divided by the cap rate. So that means if you can make modest improvements to your NOI, you can create major increases in property value through math. So say you're able to increase your net operating income by 100,000 annually, and you're going to sell the property at a 6% cap rate. That NOI could potentially create a massive value increase. And 100,000 divided by 0.06 is $1.667 million. And that's the power of value add commercial real estate. Let's talk about expense optimization and how that's often the fastest path to equity growth. And many investors really only focus on rent increases. However, expense optimization can often produce faster and more controllable results. So common areas where operators can improve their profitability will be to look at utility optimization and talk with an electricity broker, or LED lighting conversions, HVAC upgrades, smart thermostats, water conservation systems, utility bill audits, insurance reviews, rebidding your policies, reducing unnecessary coverage overlap, also improving risk management, and make sure you are proactive in property tax appeals. And Texas commercial property taxes can significantly impact NOI. Successful tax protests can materially improve your annual cash flow. So vendor contract optimization, landscaping, security, janitorial, waste management, maintenance contracts, operational efficiency, better collections, digital management systems, tenant communication improvements will all reduce your turnover costs. And many underperforming properties simply suffer from poor operational oversight. So let's talk about why Houston, Katy, and Fulshear offer strong value add opportunities. And the Houston metro continues experiencing population growth and infrastructure expansion, and businesses are moving here. Areas like Katy and Fulshear continue seeing rooftop growth with the master plan communities, but also retail demand follows and industrial expansion, as well as medical office growth, and there's service-based business expansion and mixed-use development activity all throughout the area. And as growth expands westward, investors are increasingly searching for older or underperforming properties that can be repositioned. So some opportunities can include older retail centers, small industrial parks, flex space, repositioning medical offices, or an office to a mixed-use conversion, or underutilized land tracts. Many of these assets may not look attractive on paper today, but strong operators recognize the future upside. So the best investors think like operators. And the difference between an average and an elite CRE investor is often operational thinking. And strong investors will ask, how can this property operate more efficiently? And what expenses look bloated? Where's the hidden NOI? What is the tenant experience right now? And what could be repositioned? Is the management weak? Does it need improvements? And can we deliver a better financing structure to improve our returns? The best deals are often found where others see problems. Financing matters in value add deals. The financing structure can make or break a value add just any value add investment. And some investors overpay for short-term debt or underestimate the renovation timelines. But some common financing options here would include bridge loans or debt service coverage ratio loans or SBA financing for owner users or construction loans or value add multifamily financing. There's also local bank commercial loans. And be sure to ask about interest reserve structures. And at the Viking Enterprise team and at Medallion Funds, we help clients analyze both real estate opportunity and the right financing strategy behind the deal. Because sometimes the wrong loan structure can destroy an otherwise strong investment. So let's have some final thoughts for the day. In commercial real estate, the prettiest deals are not always the best deals. They're the ones that invite the most competition. And many high-performing investors build wealth by solving problems that others avoid. And value-add investing and expense optimization will allow investors to create equity to improve their cash flow and reposition underperforming assets into stronger long-term investments. The real key is understanding operations, financing, market positioning, and long-term strategy. And this is where experienced advisors and strong underwriting become critical. So if you're looking to acquire, to refinance, or to reposition commercial real estate in Houston, Katy, Fulshear, or surrounding Texas markets, our team would love to help. And that is it for the day. Please visit my website, HoustonRealEstateBrokerage.com. You can schedule a consultation. I'd love to have a conversation. Thanks for watching. Have a good day.